Today I'm going to talk to you about value stocks and value investing. Brian's going to come up and talk about growth stock investing when I'm done. So what is a value stock? How do we define it? What are its characteristics? Well, if you look up here at the slide, you see typical characteristics of value stocks. The first one, lower price earnings ratio than the overall market. That's a pretty classic definition and one that we use a lot here at Landaas. Lower price to book ratio, lower price to cash flow. Typically, value stocks pay higher dividends than the overall stock market, and they do so with less volatility, what we refer to as beta, that is narrower price swings up and down than the overall stock market. So we love value stocks at Landaas, and with us it's all about getting a deal on what we buy, but understand it's not always that simple. For example, right now, due to low interest rates on bonds and the fact that investors are still kind of skittish after the Great Recession in 08 and 09, investors have moved into the value stocks for their dividends and for their low volatility. And as a result, in some of the areas, specifically utilities and telecommunications stocks, they've driven the prices up, and the price-earnings ratio is up to a point where it really begs the question, are those even value stocks anymore?
Mark talks about the characteristics of value stocks. Growth's kind of on the other side of the equation. Simple definition for growth stocks is above average price, but like everything, it can be more complicated than that. When you look at your Morningstar reports and you see the divisions between value, core, and growth, those determinations are made as a composite of 10 different data points. So that can be a bit more complicated. When you look to growth, what are you looking for? Really, you're looking for companies that have a higher expected rate of growth, and as a consequence, a higher expected rate of earnings. Now, the problem is nothing's for nothing in this world, and you're going to have to pay more for growth. If you pay more for growth, it stands to reason that you have a greater risk for loss. So there's potentially more of a downside. And certainly there's greater volatility as you start to separate the good from the bad and the winners and the losers in the world of growth. You know, and I like the certainty of dividends. You're not going to get that very often on the growth side. Most growth companies are taking every available penny and reinvesting it into the company in terms of new technology or new developments.
So there are some things to watch out when it comes to value investing, and one of those is what's called the value trap. And a value trap is a stock that's been trading at low multiples for a while, and the trap, if you will, springs when you buy the stock, and not only does the price not go up, but it could continue to go down. So you've got to be careful when you see a stock that's trading at low multiples, low price to earnings ratio, etc. It often means that there's a problem with the company or in the industry that that company participates in. So you can't just look at the price, look at the valuations, and assume it's a good buy. Another trap, if you will, is what we call the dividend trap. And that is a stock that's paying a high dividend because its price has moved lower, has a high dividend yield. For example, if you look at a $100 a share stock and it's paying a $2 a share dividend, that's a 2% dividend yield. Well, if the price of that stock drops to $50 a share, that $2 a share dividend is now a 4% dividend yield. And that can look pretty appealing. But if the reason that the price on that stock has fallen, for example, is because revenues are down, and now the only way out for that company is to cut costs, one of the quickest and easiest ways to do that is to cut or even eliminate its dividend. And if that happens, so now you not only own a bad stock, but your whole reason for buying the stock in the first place, the high dividend yield, is gone. So instead of just looking at a high dividend yield, we recommend you look for stocks, and we like to look for stocks that pay a reasonable, consistent dividend and that gradually raise their dividend over time. And this is an area where good, active management can help identify those types of stocks and help us avoid the value traps and the dividend traps.
If you look at the last year, value has beaten the pants off of growth. You don't typically see that kind of disparate performance, but over 3, 5, and 10 years, just the opposite is true. Growth having done quite a bit better. And when Bob makes his comments about us being a shop that has a tendency to lean a little bit toward the value, that evidence is borne in the 20 and 30-year numbers, which you'll see shows that value has a slight edge. Now, who wouldn't want to take a little less risk and make a little bit more money? But as I mentioned, the fact of the matter is lots of opportunities on both sides of the equation. And I think as we look forward, it's not going to be about one asset class necessarily over another. You aren't going to outperform necessarily by leaning a little bit into value or leaning into growth. But I think you're going to have to go a little bit deeper into sectors and into industries, and perhaps even the good versus the bad companies within those industries to have outside performance.
Where do we usually find stocks with these types of characteristics? Lower price multiples, higher dividends, lower volatility. Well, if you look at the chart, you see the middle column there is the Russell Value Index weightings of different sectors of the economy. Financials make up currently over 27% of the Russell Value Index. Stocks like Berkshire Hathaway, the banks, the credit card companies. The next one down, energy, over 13%. Again, the larger companies like an ExxonMobil, Halliburton, the big integrated oil firms. We wouldn't be talking here about the shale companies or the frackers or small exploration firms. Those would really fit more into the growth category. Utilities and telecommunications stocks, I mentioned those. Typically high dividend payers, lower volatility. And then those last two, the industrials and consumer staples, they're represented in the value index as well, but we usually consider those more core holdings, kind of sitting between growth and value stocks.
I wanted to take a second just to kind of walk you through different growth sectors and point out the differences that you might see from one to the other. First of all, technology, consumer discretionary, and health care stocks make up 2/3 of the growth equation. It's dominated by those three sectors. Technology plays a big role. I also want to point out that in what we would consider to be more traditional value sectors like the industrials, consumer staples, and material, that there are still growth opportunities in those sectors as well. Different way to look at it. If you look at the sectors and their weightings toward value and growth, you'll see again that not just consumer discretionary, but consumer staples make up a substantial part of those two sectors. Healthcare, also a big growth player, and the most obvious one, technology. I like all three sectors for different reasons. As I've mentioned, the improving labor story lends me to believe that the consumer will play a greater role in the months ahead. On the healthcare side, demographics will drive markets for many years. And I think, when has technology not been an important part of who we are? The enormous amount of cash that's not being put to work now, someday, somehow, some way, something's going to change that. And I think that's going to speak well for where technology can be a part of your portfolio in the years ahead. Also, I like to look off the beaten path sometimes. Commodity prices have been destroyed over the last 5 or 6 years, which seemed to me that there have to be some good growth opportunities when you delve into the world of those companies related to and dependent on material prices.
So when do the different types of value stocks tend to do well? Well, if you look at this chart, if you look over on the left-hand side, in what we call the economic growth phase, the early part of a typical business cycle, you see that the financials usually do well. The economy is rebounding, activity is up, people are looking for home loans, businesses are borrowing money, so you would expect the banks do pretty well in this environment. You look later in the business cycle, and that's where we are now, in what we call the expansion phase. The energy stocks tend to do well. And then finally, late in the business cycle, in recession, investors are looking for safety, they're looking for higher dividends, they're looking for lower volatility, and you would expect telecommunications and utility stocks to do well. But guess what? We're not in a typical business cycle. And as a result, in a period right now where you would expect energy stocks to do well, they're not. And that's because low demand for oil globally, due to the slowdown in China, due to the slowdown in the global economy, as well as excessive supply with the advent of the shale drillers and the fracking. more oil on the market, driven the price of oil down, so the energy companies aren't doing well. On the other hand, utilities and telecommunication stocks are doing very well. Now, they've backed off in the last couple of weeks, but year to date, they're some of the best performing stocks in the marketplace. And again, it's because people are looking for dividend income to replace the interest income that they haven't been able to get on bonds with the low interest rate environment. And they're also looking for perceived safety, lower volatility of those types of stocks.
Mark showed this slide. I'm going to build off that with 4 points, if you will. My first point is you'll find growth in all 4 phases of the business cycle. Okay, in the beginning of the cycle, you'll typically see as companies come back and individuals come back to a better place that they take those additional funds and invest in technology or they invest in consumer discretionary. You know, Mark made a mention to this perhaps not being a typical cycle. Bob talked about the piles of cash that are sitting out there. Companies and consumers have not spent their money in a typical fashion, which tells me that we still have that opportunity in the second half of the cycle for that to occur. So I think technology and consumer discretionary stocks will be a big part of growth story in the months and years ahead. Point 2, you know, I think because this is an atypical business cycle, perhaps you really hope to see some evidence that the consumer dives in. Just last week we saw that median household income rose 5.2%. That may be a really good sign that consumer, in addition to some of the other things we've talked about today, becomes healthy and contributes more in the months ahead. Point 3, healthcare typically fares better in the second half of the cycle. You're going to need help if you're sick. You're going to invest in new medications whenever they come available, irrespective of the economy. I also think demographics are really important in the healthcare area in the months ahead. The aging of the population, the ability we have to live longer, healthier lives with a little bit of help from the medical community will assure us that healthcare will be an important part of the growth half of the equation in years to come. And also a final mention that growth is often less interest rate sensitive. Many of the value style companies have high fixed costs, high debts, which require interest payments, typically not the case on the growth side.
So as I finish up here, let me just leave you with something to consider, and that's the case of Apple Computer. Apple started out, as you know, as a small technology company. It had no dividend, only started paying a dividend a few years ago, had a high price-earnings ratio, exhibited exponential growth. It was clearly a growth stock. We look at Apple Computer today, and it has a price-earnings ratio below that of the S&P 500, generates enormous cash flow, pays a dividend right along the dividend yield of the S&P 500. So I think you would be hard-pressed to say Apple at this point is anything but a value stock. And the point here is that over time, a company often moves from a growth phase to a value phase. And it can even move back from value to growth. If Apple comes out with the next big thing, it could very well become a growth stock again. So when you're setting up a portfolio and you want a balanced portfolio, you've got to keep watch and make sure that you don't own something that you think is still growth and has become value or vice versa. It's all about asset allocation and balanced portfolios.
I don't know what it is about me, but I think I could explain almost anything in the world in 4 square boxes. It seems to work for me somehow. I like this way of looking not just at value of growth, but as different ways that we approach investing from a strategy standpoint. On the left-hand side, you'll see high cost and low cost at the top, low cost at the bottom. Left to right, you'll see lower growth on the left, higher growth on the right. So, in a traditional way, lower left-hand corner, you'll see low-cost stocks with lower growth opportunities, classic value. Classic growth, on the other hand, is just on the opposite side, higher growth, but you got to pay a higher price for it, okay? So the 2 other boxes that I'm kind of fascinated by, on the lower right-hand corner, growth at a reasonable price, GARP, Can I buy companies that have great growth expectations and get a deal on them? Right? We've talked about that a couple times already, getting a deal on something. I think this is as close to a summary of our investing philosophy as there is. But what's really interesting to me is the upper left-hand corner. Are you going to pay more to have less expectations for growth down the road? And we call that anti-growth at an unreasonable price. I think that's the part of this where you'd probably avoid the most, right? Isn't it interesting that this has been the best part of the market? Okay? Why is that? People have avoided risk. They've paid more for the less risky stocks than they should have. And I think the last couple of weeks when we've had some volatility, you've seen that come back quite a bit. So we like to think of things in terms of those four different opportunities. So anyway, it's not one or the other, it's both. We think there are great opportunities for both. It may not be as easy as leaning one way or the other. It may be an opportunity to go a little bit deeper in the months and years ahead. But there are opportunities, and we're looking forward to picking through those opportunities on your behalf.